So, if you were to take a look at the SPX and say, which one comes first? 2200 or 2000? It's really a difficult question now. And on Saturday morning, I was with a group of traders. And obviously, you got an ascending triangle. You got a lot of resistance here. But if we were to actually break out through this, you'd be able to make a strong case that it'd be a continuation pattern, that you should have another leg up in the S&P Broad Market Index. And that could easily take you, another 100 points on the SPX. But when you look at some of the things that are happening across the different indexes and across other indicators, there's a lot of mixed signals right now. And you could very easily even have a false breakout just to simply come crashing back down to the bottom of the range, or perhaps that finally a topping pattern and a breakdown into something more of a correction territory, taking you down, to 2000, 1980 would certainly be easy targets to see if we were to get a correction. So a lot of mixed signals going back and forth here, and what do we make of it all? Well, in part, what we do is we focus on the here and now, what the chart patterns are telling us right today. In terms of the overmarket action, the four broad market indices, all very much at scratch. Remember, on Friday we had on the backs of the employment report a big gap up, and then for the most part a narrow range sideways action during the cash day. That actually gave us a pretty poor structure, and if we were to drop below about 2107-ish area, you could see a gap fill to take us right back to where we came before Friday's action. So watch that on your intraday charts today. See if this area holds or builds, or do we start to fail? And if we start to fail, we could very easily backfill all that action. But right now, there's nothing in the four broad market indices to tell us that that's going to happen. We're all essentially scratch on each of the four. Crude oil down about 2/3%. Euro down about 0.5%. Bonds down about 0.5%. Gold down about 0.25%. But that's certainly it in the story in the overseas action. China had a couple big macroeconomic reports come out over the weekend, as well as a decision from their central bank about interest rates. And look at this, China up over 3%. At this time. Hong Kong up about 0.5%. Japan up nicely as well, up 1.25%. Germany down over 0.5%, and the United Kingdom essentially scratch. So our Eastern Asia counterparts certainly were the heroes of the overnight action. In terms of macroeconomic reports coming into today, really nothing on the schedule for Monday to get excited about by any means. In terms of tomorrow, you have a JOLTS job openings, you have an FOMC member Williams speaking. I'd say that's about it in terms of anything of any significance. So pretty quiet here at the beginning of the week. And we'll get into later parts of the week tomorrow and going forward, but I believe there is more of significance to the later part of this week. In terms of volatility, obviously big up day on Friday, and that leads to smaller volatility. In fact, the VIX short term 11.32. And look at these IV percentiles, 8, 15, 20, 23, all in the lower quartile. So very small amount of volatility being implied in the market at this point. We did have standard deviation moves in 3 of the 4 indices on Friday, including a 2 standard deviation move put in by the Dow. So pretty significant there. I always find it interesting to see the difference between what the VIX and the IV percentiles are telling us about volatility versus what actual price action is doing. You look at this, even in the last 2 weeks, there's quite a few standard deviation moves, and yet the percentile and the VIX and so forth would seem to indicate that there is very, very little volatility, and there can be significant volatility going on, but that doesn't necessarily mean that it's fearful. And that certainly is where the VIX and the buying of the puts comes in, the way that works. But yet at the same time, if you're trading swings or doing option income strategies, you're actually having to manage around price volatility, and we certainly have had price volatility in the last 2 weeks. In terms of our regular daily report, again, very mixed signals here. You know, we've had the breaking of support levels. We broke diagonal and horizontal support, and then and I think I actually mentioned it in the video, maybe it was Thursday morning, but you know, hey, 2 days from now we could actually be 80% of the way back up the range, and good gosh, look at this. I mean, so here we are Thursday morning. We probe, break the diagonal and horizontal support, and then where are we? 2 trading sessions later, we're back up here near the very, very top of the trading range. So it's just a kind of an amazing kind of market where we seem to bounce back and forth, and yet in real terms not go anywhere. But right now we are calling this the break of support levels. So that's the last thing. We do not yet have a higher high. We haven't actually established anything new to say that we're in phase 3 or something that is a stronger market phase than this most recent incident of breaking the support level. In terms of our investor postures, IBD status has market in correction, a serious warning there. GMI index has a sell signal since 5/7, though obviously Friday's action did help, and we went from a 1 out of 6 to a 4 out of 6. Has not yet generated a buy signal, though a strong day today could generate a buy signal on the GMI index. From an active trader market posture, we have a weak bull, and you know, we're pretty cautious with this right now in terms of the signal that this indicator is generating, because it's been flip-flopping back and forth. But it is technically a weak bull, which would technically tell you that you could take new short-term and intermediate-term bullish. And given the fact that we've had such a flip-flop back and forth and the pot odds are so poor right now, combined with the weak structure, I've still left this as no new short-term and no new intermediate terms. So that's kind of my personal override over what the indicator is technically telling you. Dow is also showing weak bull. NASDAQ is actually bearish. Russell is actually flipped into a very weak bull, just now crossing the 20 line. So that would tell you that it's okay to take some trades on the Russell. So you see, this is a very mixed kind of signal. You got the Russell as the weakest of weak bulls. You have the S&P as a you know, relatively stronger bull, but still, you know, just having flip-flop back and forth. The Dow doing the same. The NASDAQ actually still in a bearish stance. So, you know, you either call this neutral or you call this the weakest of weak bulls as your overall market posture. Position sizing opinions based on the IBD status market and correction, that would still tell you 0% long side portfolio exposure. So that should be also a warning there. Hedge warning status still remains a level 2. And I was with a group of traders on Saturday. They commented that, you know, it seems like every time I go to level 2, we immediately rip up. And that is actually a very true statement. Many times what we have is we have these breaks of support, and then you know, an elevated risk level. An elevated risk level is different than a probability that we are going to go into some sort of deep, you know, pullback. It is an indication of an elevated risk level, and certainly we've had an elevated risk level as of last Thursday. That doesn't mean that we are going to go down, though. And that's a very important distinction to make. And indeed, that's where the institutions clearly stepped in, especially on the backs of the Friday AM employment report, and you had the big professional gap up of some 20 points with a slight continuation during the cash market. So We've seen this actually multiple times in 2015, really going all the way back to November of 2014, where every time we probe that lower level of the range and sometimes have a false breakout just to be reversed as the institutions step in and a value proposition and buy. But then they unfortunately have been quick to take profits, especially the shorter term traders taking profits, and we've just boomerang back and forth in this range. From our volatility based metrics, we have our daily squeeze on the VIX, which is a warning sign, and then we have, obviously with this market and correction, the number of distribution day count is exceptionally high and certainly not very supportive of a bullish market. New highs, new lows on Friday. For as big a day as it was, with the S&P up some 28 points, you had only 212 new highs versus 127 new lows. Not a huge vote of confidence there. We still have that S&P crash warning sitting out there in our E-mini chart. And then on the intermarket risk aversion indicators, we have one flagging risk off, and the others are still nicely risk on. In terms of the separate opinions, option income strategies, no change really here. VIX is still inside the acceptable window, but you have the strong potential for increasing volatility, and of course you have this market and correction in GMI with a sell signal. So it is something that needs to be taken into account on your option income strategy initiations. Cover call, we've moved this up a notch, cautiously bullish, calling for a 1-to-1 distribution between in the money and out of the money strikes. And then on put selling, you have this market and correction condition. So conditions are suspect for selling puts, and this may seem kind of a mixed opinions here. And that's the kind of market we are very much in. We are in a very, very mixed situation. Whether you look at transports, you look at NASDAQ, you look at the Russell, you look at the internal charts here, and there's a lot of mixed signals. Some calling bullish, some calling bearish. You've got the poor structure. So this is the kinds of mixed signals that you get from the opinions when you have these kinds of charts. But anyhow, in put selling, look for bottoming patterns to time. Consider scaling in. Keep it as perhaps the credit spreads with defined risk to kind of control your risk. As I started the broadcast, this, are we up 100 points or down 100 points, as our next threshold? Really very difficult to give an answer to that at this point. In terms of our relative rotation graph, look at this. I mean, this is just flat out ugly. So you have, our strongest areas such as FDN and KRE, and yet the percent change is really quite marginal. And you have an awful lot of the sector leaders that are just flat out tails heading to the south side. So this should say an awful lot about what your pot odds are for initiating new positions right now. It's just not a strong breadth to the market to be able to take new positions. So from a sector standpoint, obviously on the market postures, with Friday's action, you get a lot more green, but again, we have these flat average lines across these areas right now, so they've just been flip-flopping back and forth. But telecom certainly is a laggard, not performing very well right now, so I would certainly make that point. Utilities also continues to be crushed, and while they were the heroes of 2014, they may very well be one of the poor sector stories for 2015 as interest rate products continue to be hit. Retail continuing to show relative weakness to other sectors, and early and certainly most of first quarter, retail was the hero. From a percent change on Friday, financials held up very well, and certainly that's a big key to watch if we're going to say, are we going to backfill that gap from Friday morning? Well, financials, as long as they hold up, it's unlikely that we would backfill. But if you start to see the financials break down, and that could very much be a tell to look for a further breakdown and backfill of this recent ranging action. and energy was down pretty significantly on Friday. So that continues to be quite a volatile sector and requiring more nimble trading. In terms of industry groups, interesting enough, Shadow Trader has retail as the #1 industry group, internet, healthcare, railroads, biotech as your top group. So take a look at the components of those industry groups as your watch list, but we would be very, very cautious in terms of initiating new short-term, intermediate-term positions at this point, given the combination of the hedge risk level, our IBD status, GMI index, a very, very difficult area in which to initiate new positions. It's mostly about risk control at this point. That should be enough for today. If what you're getting here is helpful to your trading, we greatly appreciate you investing back in us and liking us on YouTube, and then of course sharing what you have found here with your trader community. More information about what we do at Falcon Global, and obviously we model these practices in our portfolio and options live trading chat room. Just get a more information at the website there. Obviously performance matters, and we're very transparent with our performance. Disclaimers as always. Hit the pause button if you need more time to review this, and we'll look forward to seeing you back here tomorrow morning in our market preview video about 7:30 Central on Tuesday morning.